Well, hello, everyone. Cynthia Tomain here with Interactive Brokers, and thank you for joining today's webinar being brought to us by EQ Derivatives. I am very pleased to have Russell Rhodes, Head Research and Consulting at EQ Derivatives, to deliver today's presentation. Now, Russell is a highly regarded strategist, educator, and consultant, among many other tasks he's done during his 25-year career. But he is probably or best known, especially to interactive broker audiences, for the decade he spent as Director of Education for the CBOE Options Institute. In addition to his current duties as Head Research at EQ Derivatives, Russell is also a Professor of Finance at Loyola University and is currently pursuing a PhD from Oklahoma State University. Now, in addition to all of that, he has just released the VIX Trader's Handbook. It's that book was just released at the end of October and includes the history, patterns, and strategies every volatility trader needs to know. So we are very pleased to have Russell with us this afternoon. So Russell, I'm going to go ahead and pass you the controls. If you would share your desktop, let's get underway here this afternoon. Thanks so much, Russell. Always good to have you with us.
Always good, and I'm really humbled when you introduce me. I really am. Is everything looking good on your end as I pull this up?
You're in presenter mode. If you can put that into full screen.
Hold on a second. How's that?
Much better. There we go.
Okay, yeah, that's what I thought. I wasn't 100% sure. So there, yeah. You list off all those great accolades, but I don't know how to use the internet. So today we're going to talk about just a few strategies that you can use, that you can implement using options on VIX or options on VSTOXX. I'll mention futures a little bit, but I feel like the strategies with the options are a little bit, they have nice risk control to them as well, but I feel like they're a little bit better suited to the clients that I'm talking to right now. And I'll clarify that as I get moving along. Here's my disclosure statement. I'm here for educational purposes only. I am going to show how a few trades would have worked over a 4 or 5 week time period, but that is not indicative of potential future results. I'm also going to show some history numbers, but again, past performance, not indicative of future results. I'm going to do a quick review of VIX and VSTOXX, the price behavior of both of them, how the futures act relative to the index, which is really a key component of the behavior of VIX derivatives, especially for what I'm talking about today. Go through a few trade ideas, one of which is every time I do something for Interactive Brokers, because they have been so good to me over the 10 years or so that I've been out there talking about trading strategies, I always want to bring something new, which sometimes puts a little pressure on myself and also pushes me up against the deadline that Cynthia is looking for. But one of the trade ideas is a multi-step trade that's something I have not talked about before. I also like introducing things on Interactive Broker Webcast because you guys are fairly sharp. I like talking to IB clients. I feel like we're a little bit, and I say we because I am included in that, that we're a little bit sharper than the average person trading for ourselves. And I like the feedback that I get when I'm talking to Interactive Brokers clients. So VIX is nothing more than an index that gives us a consistent measure of expected volatility over the next 30 calendar days, and that can be important sometimes, but the next 30 calendar days with respect to the S&P 500. Option pricing is based on a bunch of different factors. One of them is how much volatility is expected out of the underlying market. And when there is more volatility expected out of the S&P 500, VIX will go up. When there is less volatility expected, VIX will move lower. Typically, higher volatility is associated with downside moves in a broad-based index. So we do have that inverse relationship with VIX and the S&P 500. Here's the first 6 months of this year. This is a great textbook picture of how VIX will act when we come upon what I refer to as a volatility event, which the uncertainty associated with the current pandemic that really got VIX going, made it actually hit record high levels, even when we compare VIX to price action back in 2008, 2009. But this inverse relationship holds up. The correlation, depending on the time frame and the times that you use, and when I say that, I mean daily or weekly or even monthly performance, and you go back over a good amount of time, the relationship, the correlation is typically going to run between minus 0.7 and minus 0.8. Now, there are short periods of time, like maybe 2 or 3 weeks, where VIX and the S&P 500 may trend in the same direction, but typically when you put enough trading days in there, we get a really nice inverse relationship, and that's what shows up on the chart. And I notice right here, I'm highlighting where, for a couple of weeks, both the S&P 500 and VIX moved in the same direction. That does happen every once in a while, but tends to be short-lived. VSTOXX, it's basically uses the VIX methodology, and using VSTOXX 50 options gives us the same sort of measure, a consistent 30-day measure, looking forward for price action in the VSTOXX 50, which is a great pan-European index. And like VIX, VSTOXX has that inverse relationship as well. In fact, if I didn't label this chart and threw it out on Twitter and said, tell me what this chart is, didn't put VSTOXX 50 and VSTOXX, but put the dates, and I said, tell me what this chart is, I think 90% of people would guess this is VIX versus the S&P 500. And the point is, they do have very similar price behavior with respect to, and all volatility indexes based on broad-based option markets, such as there's one on DAX, there's one, I think there's one on the Hang Seng now, there's one on the Nikkei. The relationships typically look very similar to what I'm showing you right here. Now, and just taking a look at VIX versus VSTOXX, they do tend to trend together. I did do a webcast, I want to say 2 months ago, it's somewhere in the archives, where I talked about trading the relationship between these two markets. There are opportunities to cross-trade between these two markets. One of the great things about IB is they offer trading on VSTOXX futures along with the VIX futures. Not every brokerage firm offers that, and that allows you to, when one gets out of line with the other, gives you opportunities to take advantage of that. I'm actually putting together some intraday data to show the relationship between those two, and I'll come back early next year and discuss that further. But I think there's great opportunities to trade VSTOXX futures by themselves, VIX futures by themselves, VIX mini futures by themselves, and also taking a look at the relationship between the two of them. Now, this is the typical price behavior for VIX futures. And I'm going to talk about VIX option trades, but we care about VIX futures because the best underlying pricing for VIX option contracts, especially when they have 3 or 4 weeks left to expiration, are the corresponding future versus the spot index. And you can see back here, we had an instance where the VIX future was at about a 3-point premium to spot VIX, and this is actually the date that I'm going to use for the option trades that I show. Because what I'm really getting at with this webinar is taking advantage of this spread and the compression of that spread. And you can see that they do as we approach. This is basically every day up until the day before expiration for the September VIX futures contract. And you can see as time goes by, and of course we did have a rally up in VIX, but as time goes by, the spot future does start to, or the front month future does start to follow the spot VIX index very, very closely. So as I mentioned, we're going to take a look at option pricing from August 19th, 2020, when the September future again was at actually it's almost a 4-point premium relative to spot VIX. And there's some things I want to point out with respect to the option pricing here. And what I used for the option pricing here is I used the midpoint of the bid-ask spread on the close. So for instance, right here, the 20 put was 30 by 35 cents. So if you were to purchase any of these put options, I highlighted what the break even at expiration would be. And where the color changes here, these are actually options that would make money if VIX is unchanged between August 19th, 2020 and VIX settlement. Now that's not a reasonable assumption, but if you were to have, and this is not one of the trading examples, but I want you to get a visualization around how VIX options are priced with the September future at a 2.5, 3-point premium relative to, or almost, sorry, 3.5, almost 4-point premium to spot VIX. If you took a look at buying the 30 strike put, and let's just say you got filled at the midpoint of $6, the break even on that trade is 24 at VIX expiration. Now VIX, lo and behold, is down at 22.54 at that time. So the put options give you these really cool opportunities if you think VIX is going to be unchanged, or if it's going to trend lower. They kind of give you a little margin for safety relative to the spot VIX index. This also, and I tend to get this question about a couple times a month. I recently got this question from one of the students that I have at Loyola. They were asking, why does it appear that that the at-the-money option contracts, which would be these options right here, the 22s and the 23s, why do they appear to be, why are the puts so much cheaper than the calls? Well, that's because these options, these September options, are being priced off of the futures contract, but they are settling into spot VIX. So first trade, just taking a look at and kind of taking advantage of that extra premium that you're getting from the option contracts with respect to the future being at a nice premium relative to the spot index. So right here, we've got I'm just putting on a bear call spread. I know it's not very exciting. I'll get to a more exciting trade in a second. But it's a good, straightforward way to go about taking advantage of this. If you think VIX is going to remain, if you thought VIX was going to remain unchanged or finish under 25, this is a great way to go about trading that. And the reason I think it's a great way to go about trading that is because you know what your potential risk is. A lot of us have fairly short memories, and it had been a long time since we had gotten a really, truly violent volatility event to the upside, but we did have one back in the first half of 2020. So I always, especially when I'm thinking about a short volatility trade, I want to know the most that I can lose. And I think that's a great way to approach every trade, but especially for a short VIX or a short VSTOXX trade. And here's what the payoff diagram looks like. It's got a nice buffer in here with respect to the break-even level, or the maximum profit that would be realized if VIX is at 25 or lower. And what I did a little bit differently with this webcast, and something I've not done before, I'm actually going to show what the P&L would have been over the life of this trade. And I chose the August expiration period because VIX did rally up and came back down. And here's how the P&L would have looked over the life of this trade. Wouldn't have done a whole lot. If you'd held it through September, we would have been looking at an intra-period loss of around $2, and then the trade at settlement actually would have given you a return of $1.40. I actually priced it out until the day before settlement, but I just want to take a look at how much pain would you had to endure through this call spread. And it's easy to endure pain like this when you know the very worst case scenario could have been a loss of around 360 or so. It's not as easy to endure pain that's associated with being short something sometimes if you don't have a cap on how much you could possibly lose. Now, the second trade takes, and this is actually a broken wing butterfly. And I wanted to put together a broken wing butterfly because one of my great mentors, Jim Bittman, who was head of the Options Institute at SIBO when I started there, he used to have this multi-step trade that he liked to actually demonstrate with NASDAQ options, which is a pretty volatile market as well. But what he would do is he would, with about a week to go, and my time frame's a little bit different here as well, but with about a week to go, he would put on a trade that would make money if the underlying didn't move too much, would make money if it moved up a little bit, but allowed for a managing opportunity if the trade or if the underlying rallied too much against him. And he liked to do this to the downside because of the higher implied volatility for out of the money put contracts. I'm not using out of the money put contracts, but it's something that he liked to demonstrate, liked to trade with, and did fairly well with it. Now, here's what the payoff diagram looks like for this trade here. And you can see if VIX drifts a little bit higher, is up around that 29 level, things turn out fairly well. If you stay at the low levels, you make around 50 cents. There's some substantial upside risk here, but there's a rule associated with managing this trade that I'll get to in just a second. I'm going to show how this trade would have worked over time, and then I'm going to get into the managing transaction. So you can see that 2254, nice buffer. You actually got a buffer on this trade up to, around 32.5 or so, where you don't have too much to worry about. If you get above 32.5, then we have to start worrying about losses down to, about $8.50, I believe. This is what the P&L looked like for this trade over time. And that's pretty interesting because spot VIX did rally up to the mid-30s or so. And the loss at this time, really, it only bottomed out around $1.50 or so. And as VIX moved into and the future moved into a range around that upper 20s level, there was actually an opportunity to get out of the trade at better than 50 cents because we were in, and I'm going to go backwards for a second. We were in this range right here for a little while. We were also up here for a little while as well. Now, there was the rules-based trading or the rule that was associated with doing this with NASDAQ options would involve if the future or the underlying moves above the break-even level. And if the underlying moves above that break-even level, which it did on September 3rd, the managing transaction involved selling the long call and selling the low strike long call and buying another of the high strike call. And this is basically, we take this broken wing butterfly if the underlying rallies up, and we take it from being a single broken wing butterfly to being two bear call spreads. And in this instance, we could have sold the 26 call for $8.60, and we could have bought the 40 call for $2.75. And what we end up with is this trade for a net credit of $6.35. Now, we still have some pretty substantial upside risk associated with this trade. We could lose as much in this case as $13.65 because now we're short two call spreads. But VIX has a tendency, it doesn't always do this, and it did not do this back in the spring, but VIX does have a tendency to spike up and come back down. And when you're looking at a market that tends to have extra volatility where it looks like a heartbeat, zigzags up and down, that offers opportunities to do this sort of trade. And I'm applying this as an example right here. What I'm actually going to do is I'm going to go back and replicate that, basically put together a rules-based situation where I put together a broken wing butterfly based on certain criteria for each of the strikes and manage it based on a rule as well, and just see how it worked over time. And I do know that there will be some instances where it really got run over. But I think this broken wing butterfly to a short call spread, I think this is actually a trade that makes sense, understanding the nature of the market it was created for, which was the QQQs and the NDX, and understanding the market, understanding the behavior of VIX and VSTOXX as well. I'm going to try it out with both of those. And so this is the new payoff diagram at that point. We're pretty close to break even. If we work our way back down to the downside, we can do fairly well. If we end up here to the upside, and I'm actually questioning, I think maybe my line should straighten out a little bit higher than that. But I think it's a good managing trade with VIX, and a good always be there when VIX is maybe just drifting lower and behaving the way that it normally does, but also having a plan in place to manage a trade in case we get some sort of rally in VIX. And goodness knows we can get very quick rallies in VIX. They tend to subside pretty quickly as well. Now, switching over to VSTOXX and kind of the same time frame there. One of the neat things about having VSTOXX available to trade along with VIX is they don't always move in the same direction. If there are regional issues that, Europe-specific issues, and Brexit would be one. We saw VIX and VSTOXX disconnect. If there are U.S.-specific events, and we actually saw a disconnect between VSTOXX and VIX going into the U.S. election, and they came back in line with each other. VSTOXX and VIX trend pretty close together, but they do disconnect enough, and sometimes there's an opportunity to trade one where there's not necessarily an opportunity to do a trade in another. So I always feel like you should be doing the either or thing. And hold on, Henning, managing trade means out to the broken butterfly. Yes, the managing trade, I'm going to go back real quick before I start digging into the VSTOXX trade. But the managing trade was basically selling the lower strike call at for 860 and buying another one of those 40 calls. And the managing trade turns that broken wing butterfly into basically two bear call spreads. And when the market spiked up, it gave you the opportunity to do that. So I hopefully Henning that clears that one up a little bit. So with respect to VSTOXX, showed that the price activity is somewhat the same. The options do the same thing with respect to being priced off the future. In fact, VSTOXX options are options on futures. So it's almost silly saying that they're getting their price off of the futures contract, but they are. But over time, the futures contract is going to gravitate toward the spot VSTOXX price. And back on August 19th, the September future went out at 24, and spot VSTOXX, I came really close to saying spot VSTOXX was at 22, but I decided to be very specific because I get called out on those things sometimes. So it was at 21.98, about a 2-point discount to the September future. And again, you can see I changed the color on options that would make money if VSTOXX did not move at all between August 19th and September settlement. And see, you would have made a little bit. You could have bought the 30 strike put for, and I use the midpoint here, so let's say for 735 if you're going to end up paying the offer side on that. and you would have ended up with a break even of 22.65. So about a 65-cent buffer right there. The spread was not as wide between the VSTOXX future and spot VSTOXX when compared to VIX and the VIX future, but so the break even's a little bit closer to where spot VSTOXX was on this table than on the table with VIX. But that's an instance right there where there are times where the VSTOXX future might be at more of a premium, and the opportunity to do a trade like this is better in VSTOXX than it is in VIX. So just another taking a look at a bearish trade that actually does very well if we're right at 22, which is the basically where the spot VSTOXX was when this trade was priced out. Could have bought the September 27 put for spot 775 and sold the September 22 put for one spot 275. We do see trades in the VSTOXX complex that go out three points like this, or out 3 decimal points like this very frequently, actually, especially when we're looking at block trades. But in this instance right here, we actually, the payoff at expiration, you can see where the spot VSTOXX is just sitting there. You get a nice drift lower, and I've always, I got to get an illustrator, because I've always wanted to have an illustrator take the 24 and take this line and just have them shift over as time goes by. It's almost like a way to make money off of the time decay that is basically the VSTOXX futures contract relative to the spot VSTOXX. So, and here's how the P&L worked for this trade. This trade actually was a little bit of a bumpy ride, but VSTOXX and the September future did come under pressure toward the, as we approached expiration. They narrowed the gap with spot VSTOXX, and this trade would have turned out fairly well. Actually, it would have, I believe, at expiration, it would have realized a full profit of $1.50. So, or $1 or 1 spot 50 euros. I should be very specific with that one. So, with that, I just really wanted to demonstrate the options, the option pricing, how it's a little bit unusual for both VIX and VSTOXX, how a couple of spread trades that might work out. One thing you can do is you can always take a look at, if you think the premium of the future relative to spot is too high, you can take a look at shorting the futures contract. That's a pretty straight up trade. I just wanted to show some alternatives around that. I actually, pretty frequently, and it's not a very exciting trade to demonstrate, but if I see enough premium in an in the money, VSTOXX or VIX option relative to where the spot is, and maybe we're approaching expiration, I am a big fan of just buying puts that have what I refer to as negative time value. But today I wanted to take, which is a very straightforward way to go about taking advantage of this pricing characteristic of the volatility derivative markets. However, I wanted to take it a step further today. So with that, I know Cynthia's close by. She always is. If there's any questions, feel free to send me an email. And I say that I actually have 2 emails from Interactive Broker clients that I haven't responded to yet. And I promise I'll get that done in the next couple of days. We ended a quarter at Loyola. So I've been a little bit more of a professor and a little bit less of a EQ derivatives research person. Whenever I'm doing anything, whenever I see anything interesting in the markets, I'm actually going to start posting short videos about trades and market activity more than once a week, and all those will be found at my Twitter account, and also we're setting up a place on YouTube to save all those things. So those are the ways to get hold of me and to know what I'm up to. And Cynthia, what's up?
Well, I'm right here, Russell, and I do want to remind everyone that if you do have any questions, now's the time to put it into that questions panel over on the right-hand side of your screen before we do end today's session. But I also, a couple of things I wanted to point out. If you'd like a copy of Russell's slides, notice in the control panel in the handouts pane, there's a PDF version of these slides. So if you'd like a copy, you can download directly before you do exit today's event. Also want to let you know that we have been recording today's session, and each of you will get a direct link to today's recorded playback shortly after today's event ends. So if you do have, you want to come back and revisit those concepts, simply watch your inbox later on this afternoon. I see Russell moving his slides, and another question came in. So I'm going to be quiet for a moment and turn it back over to Russell to handle those questions. Thanks, Russell.
Okay. All right, Juan, thanks for the question, and this is definitely described better with the option pricing. Now, it's not accurate to say there's negative time value here, but let's say you buy the 30 strike put for $6 and VIX doesn't move at all. Well, first off, and you plan on holding it to expiration. Well, you can think of VIX as being, the instrument that you're going to focus on here, not necessarily the futures contract. And if VIX is at 2254, and when we demonstrate time decay, we always say, okay, here's time decay if the underlying market doesn't move at all. So if VIX is at 2254 and we buy the 30 strike put for $6, over time, the future is going to creep down, and you're going to see this premium right here move higher. Or another way to think about it is the intrinsic value for this 30 strike option based on the spot index being at 2254 is actually what, $7.46. So you kind of have negative time value of $1.46. I know that's, again, you can poke holes in that, but I think it's a good way to think about options, VIX options that have less intrinsic value than they would if you compared them to the spot VIX index. And that's what I mean by that. So hopefully that clears it up. And that's one of those terms that I kind of created myself. Typically I'll show buying a put, and I'll show like buying a put and the break even might be somewhere like here, and the index is about here. And you can see that all else being the same, that you would make money on the trade just by allowing time to go by. Francis is asking about historic options data. I use Bloomberg, which I know is not an option was just not an alternative for a lot of people. But I use the two SIBO products that are out there, and I use them on my own dime, so I'm not trying to sell you on them. But I have LiveVol Pro, and I also have Trade Alert, which was created by Henry Schwartz and is an excellent tool to go back and look at block trading activity. And then I probably really like the LiveVol from SIBO because as they developed a lot of the tools, I worked there and I actually got to have some input in the tools. So it's like, of course, I like that one because it does exactly what I asked. But those are the two things those are the two places that I go for option data. You can get futures data, daily futures data from both VSTOXX futures and VIX futures directly from the respective exchanges. So that's a good place to work as well. Marco's asking if a butterfly strategy is good for VIX. I think the butterfly strategy is good if it's a broken wing butterfly where you can make money if VIX drifts lower, or if it's always possible to put on a butterfly that makes money if you get a big move to the upside. the traditional iron condor and butterfly strategies where you're shooting for at the money and expecting the underlying market not to move around too much, that becomes a little bit convoluted with VIX because again, the options are being priced off of a futures contract, and the futures contract has a disconnect from spot index. So the time decay benefits that you would get from a neutral trade like that are not the same in the volatility space as it would be in the equity, the traditional index space, or the ETF space. Oh, and you mean the last day before expiration? Absolutely not. And the butterfly for the because there is an awful lot of overnight risk for what VIX and VIX futures can do between the traditional close on Tuesday night and Wednesday morning settlement. In fact, the reason that all of my profit graphs stopped the day before expiration is because I always like to take my VIX trades off the day before expiration. I feel like trading, especially short-term trading into VIX expiration, it's really a crapshoot. And I hate using gambling, but gambling, terms, but it really is a crapshoot on that one. Trust me, I've tried to find strategies that you can use, put on the day before expiration and consistently make money on expiration, and I haven't found anything. If you find something, let me know.
Okay, well, it looks like that may be the end of the questions for today's session. I want to thank you, Russell, terrific answers there, but also point out that Russell will be back with us in December, actually on December 8th. He'll be talking about index spread trading strategies with the S&P 500, NASDAQ 100, and the Russell 2000. So if you're interested in more on those index spread strategies, you can sign up today via the Interactive Brokers website. Underneath the education menu, you'll find a webinar section where Russell's next event is listed. If you can't join us live, register anyway, and we'll send you a direct link to the recording shortly after the session ends. So with that, speaking of the session ending, it looks like it is going to bring us to the conclusion of our event today. A great deal of thanks to Russell Rhodes. Always terrific to have you, Russell. Thank you once again for joining us. And I also want to thank all of you for your participation with our event here this afternoon. Have a great rest of your day, everyone. You can exit using the X in the upper right-hand corner of the screen. Have a great rest of your day, and we'll see you next time. Have a good one, all. Thank you.